So we want the present value of $20,000 2 years from now. Going to look up this number in the table, present value of $1, 2 years at 80%, and that's the yield. And we find that the bonds will sell for $17,146. In other words, when the company issues these bonds, they are going to receive in cash $17,146, and that is also going to be the value of the company's liability, what they owe, $17,146. Any question about that? With zero coupon bonds, you're going to have to calculate what the bonds will sell for. And that's the present value of the future cash flows, where the future cash flows are at the face value. Any questions? As I mentioned before, when the IRS decided that they were going to tax the interest that was being earned along the way, if you look at that from the company's perspective, the company therefore has interest expense every year. Even though they're not paying out any interest, they've got interest expense. So, in order to calculate the interest expense on these zero coupon bonds, what you need to do is multiply the book value of the bond payable, whatever is in that bond payable account, by the yield. That's the market interest rate that we talked about earlier. So, what is the book value of the bond payable when we first get started? It's what the bonds were issued for. So we're going to take $17,146, multiply it by the yield, and we've got interest expense of $1,372. The first year, the company is going to record interest expense of $1,372. Trick question. How much is the cash going to go down? Zero. It's a zero coupon bond. The company is paying no cash, but they are recording interest expense. Well, you've got to have a second account affected. Every time you record some transaction in accounting, there's got to be at least two accounts affected. Interest expense is one. What's the other one? Well, not so trick question. Quiz question for you. The bond payable account started out at $17,146. Who can tell me what the bond payable account should be on the day that the company pays back the bond? What should be in the bond payable account 2 years from now before the company pays off the bond? Raise your hand if you know. Yeah. $20,000, because that's what the company will pay in 2 years, right? The company is going to pay $20,000 in 2 years. So the bond payable account needs to grow from $17,146 up to $20,000 2 years from now. That's the day they pay out $20,000. So when they record this interest expense, they're also going to take that same amount and put it into the bond payable account. When they record interest expense, that goes on the income statement. The liability account is also going to grow by the same amount. That means that next time when they record interest expense in the second year, the bond payable amount has grown to $18,518. Multiply that by the yield of 8%, and that will give you next year's interest expense. When added into the bond payable account, it grows to $20,000. You may have to, in this last year, move the dollars a little bit one way or the other to make sure that the bond payable account ends up at whatever the face value is. So there may be a little bit of rounding going on in that last year. But that means that after they record that last interest expense in 2010, the company now pays out the $20,000 and reduces their liability by the same amount. The bond payable goes away. Any questions at all about that? Obviously, we've got a problem coming up here in just a minute. So, any questions about what you see? Okay, let's see if you all can do one. January 1, 2009, Bond Company issued 4-year zero coupon bonds. Face value is $100,000. The bonds are sold to yield 10%. Basically, you have to do what we just did. The people selling price, which means you have to go back to your present value table And then prepare a schedule that shows the interest expense and the book value of the bond payable every year for the 4 years. Let us know if you have questions.
Yeah, you're trying to find the present value of the bond's future cash flows. And so this problem, what are the future cash flows? The bond is out, what would they do? What this is. So since it's a one-time deal, which can be
Give me another minute or so again. If you're stuck anywhere, let us know.
I guarantee you I I missed you. One because I was really first and the other I forget what I think I agreed
All right, as long as you could have gotten through the first couple of years or so, the calculations after that are somewhat repetitious. But somebody start out by telling us, what will these bonds sell for? Somebody tell me what is the issue price and sale price of bonds? Yes.
68,300.
How many have 68,300? Raise your hand. If you didn't get that, the rest of the numbers aren't going to be right. But that is the present value of $100,000 40 years from now if you're bringing it back to present value at 10%. So you would look up in the present value of the dollar table, 40 years, 10%, multiply that by the $100,000 future cash flow. This is what investors are going to pay to the company today. So the company's cash goes up and the bond payable account goes up. That's what they owe at this point. Then we need the interest expense for the first year. Somebody raise your hand and give us the first year's interest expense. Yes, sir.
6,830.
How many have 6830? Raise your hand. Which is basically just whatever's in the book bonds payable account times the yield of 10%. So 68,300 times 10% is the interest expense in the first year. Somebody give me the second year and I'll show you the rest of the numbers. What's the interest expense in year 2? Yes, sir. How many have 7513? 7513. Because what you're doing with the interest expense is you're adding that back into the bond payable account. So next year the bond payable account was 75,130. Multiply that by 10% to give year 2. Here are the rest of the interest expense numbers. Remember that the bond payable has to end up equaling the face value at the end of that 4-year period. So the fourth year's interest expense, you might need to round it a little bit one way or the other to make the bond payable equal the face value when the bond comes due. Any questions at all? Yes, sir.
We just put that rounded number, interest expense on the balance sheet.
That rounded number would be in two places. It would be an interest expense on the income statement, and it would be a bond payable on the balance sheet. We're adding the same amount, therefore it's bringing the bond payable up to the face value, whatever it is. Yeah. Other questions? Okay, we'll continue on Thursday. See you then.